Want to pick winning stocks but feel overwhelmed by all the jargon and data? Good news! You don't have to be a financial expert to invest like a pro. In this video, I'll share simple, practical tips to help you spot strong stocks, avoid common pitfalls, and build a winning portfolio. Whether you're a beginner or just want smarter strategies, these easy steps will boost your confidence and help your money grow. Let's make stock picking straightforward and stress-free. Today we will talk about how to pick stocks like a pro without being an expert. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understand the basics before diving in. Before you start picking stocks, it's essential to grasp fundamental concepts. Stocks represent ownership in a company, and their price fluctuates based on market sentiment, company performance, and economic factors. You don't need to be a financial expert to begin. Instead, focus on learning key terms like dividends, earnings per share (EPS), price-to-earnings ratio (P/E), and market capitalization. These basics form the backbone of stock analysis and will help you evaluate companies more confidently. Familiarize yourself with stock market trends and how external factors, such as political events, interest rates, and global news, impact stock prices. A solid foundation makes it easier to sift through the noise and spot promising opportunities, reducing your risk and boosting your chances of success. 2. Set clear investment goals and time horizon. Every professional investor starts with a clear goal and timeline. Are you looking for steady income through dividends, or do you want capital growth over years? Your approach to picking stocks depends on your objectives and risk tolerance. For instance, younger investors might prioritize growth stocks with high potential but higher volatility, while retirees may prefer dividend-paying blue-chip stocks for stability. Define your investment horizon, short-term, medium-term, or long-term, as this will influence your stock choices. Understanding your goals keeps you focused and prevents impulsive decisions driven by market fluctuations. With a clear strategy, you can tailor your stock picks to suit your needs and avoid chasing trends or panic selling during downturns. 3. Learn to read financial statements effectively. Even without being an expert, learning to interpret a company's financial health is crucial. Financial statements, income statement, balance sheet, and cash flow statement offer valuable insights into profitability, debt levels, and cash generation. Look for companies with consistent revenue growth, manageable debt, and positive cash flow. Key ratios like return on equity, ROE, debt-to-equity ratio, and profit margins help you compare companies within the same industry. Tools like free online tutorials and beginner-friendly investing books can simplify these concepts. Once you know how to read these statements, you can quickly weed out companies with weak fundamentals, reducing the risk of investing in firms that might struggle in the future. 4. Focus on quality companies with competitive advantages. A hallmark of professional stock picking is investing in companies with durable competitive advantages, often called economic moats. These companies have unique products, strong brand loyalty, or cost advantages that protect them from competitors. Think of tech giants like Apple or consumer staples like Coca-Cola. Such businesses tend to perform well over time and weather economic storms better than average companies. Look for businesses with consistent earnings, strong management teams, and clear growth prospects. These attributes often translate into stock price appreciation and dividend payments. Investing in quality businesses reduces the guesswork and helps you build a resilient portfolio that can grow steadily. 5. Diversify your portfolio to manage risk. Even pros know that diversification is a key to managing investment risk. Don't put all your money into one or two stocks, no matter how promising they seem. Instead, spread your investments across different sectors, industries, and even geographies. This way, poor performance in one stock or sector won't drastically impact your entire portfolio. Diversification can include mixing growth and value stocks, domestic and international companies, or various asset classes like bonds and ETFs. A diversified portfolio smooths out volatility and improves your chances of steady returns over time. Use index funds or exchange-traded funds, ETFs, if you want instant diversification without researching individual stocks. 6. Use stock screeners and research tools. You don't have to manually sift through thousands of stocks. Modern technology offers powerful stock screeners and research tools that help identify stocks matching your criteria. These tools let you filter stocks by market cap, P/E ratio, dividend yield, sector, or analyst ratings. Websites like Yahoo Finance, Morningstar, and Seeking Alpha provide comprehensive data and expert analysis. Some platforms even offer alerts when a stock meets your predefined parameters. Using these tools saves time and increases your chances of finding high-quality stocks. It also empowers you to track and analyze stocks systematically, rather than relying on gut feeling or hype. 7. Pay attention to market sentiment and news, but stay disciplined. Market sentiment can drive stock prices up or down quickly. News about earnings, product launches, or regulatory changes affects investor mood, causing volatility. While staying informed is important, avoid making impulsive decisions based on short-term news or social media buzz. Instead, develop a disciplined approach to evaluate whether news genuinely affects a company's long-term value. Professional investors often use a buy-and-hold strategy or only make changes when fundamentals shift substantially. Reacting emotionally to market swings usually leads to buying high and selling low. Stick to your plan and periodically review your portfolio to make rational, data-driven decisions. 8. Learn from experience and continuously improve. Picking stocks like a pro is a journey, not a one-time task. Keep track of your investment decisions and their outcomes to understand what works and what doesn't. Review your mistakes and successes to refine your strategy. Read books, follow market experts, and stay updated on new investment concepts. Over time, you'll develop intuition backed by knowledge, improving your ability to pick winning stocks. Remember, even professionals face losses, but they manage risk well and learn continually. Patience, education, and experience are your best allies in becoming a savvy stock picker without needing to be an expert. 9. Harness the power of fundamental versus technical analysis. When picking stocks like a pro, understanding the two main schools of stock analysis, fundamental and technical, can greatly enhance your decision-making. Fundamental analysis focuses on a company's intrinsic value by examining financial statements, industry position, and economic factors. This approach helps you decide if a stock is undervalued or overvalued compared to its current price. For example, if a company's P/E ratio is significantly lower than its industry peers, but it maintains strong earnings growth and a solid balance sheet, it might indicate a buying opportunity. On the other hand, technical analysis studies price movements and trading volumes to identify trends in market sentiment. This method is popular among traders who look for patterns like moving averages, support/resistance levels, and momentum indicators to time their entry and exit points. While technical analysis can seem complex, beginners can start with basic chart patterns and gradually explore indicators. Combining both approaches gives you a more rounded view. Fundamental analysis helps you pick quality stocks, while technical analysis assists in optimizing the timing of your trades. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.